Anthony, how is the role of CEO at a large bank evolving? And will the leaders of the future need to be techies as much as bankers?
Well, if you think about the role of the CEO today, it's very different to how it was 20 or 30 years ago. From the late 80s to the financial crisis, we saw basically an era of deregulation, of globalization, of strong economic growth. And at that time, banks were growing very quickly. Then we had all the re-regulation of the post-crisis era, where, in my view, banks were required rightly to hold more capital. And so that was all about repositioning the businesses in many ways. But now we have a new generation of bank CEOs coming in, and they're really facing a series of existential challenges for the industry. The first is about digital and the customer's experience, customers' demand for everything to be instant and to be a great user experience. But also, of course, huge pressures on the economic model of banks, particularly in low interest rate environments. And of course, now we're likely to have a big rise in credit losses because of COVID. So the challenges really are very different today for bank CEOs. And I would say there are probably three things that really matter for a bank CEO today. One is to think strategically. So think about where the institution is going to be in 3, 5, 10 years' time. The second is to build organizational capability around agility. We live in a very uncertain world. If we were talking a year ago, who would have guessed we'd be in a global pandemic now? So organizations need to be able to adapt very quickly to changing circumstances. And the third thing I would say is to really understand that the business of financial services is about data. If you look at a mortgage, it's information about the property you're buying. It's about how much income you have, how much you can borrow, etc. These are just data elements. And so while bank CEOs don't need to be techies, they do need to understand that their business runs on data, and they need to understand how to handle that data more effectively, which is about technology and about understanding not only where the technology is today, but where it's going. So if we look back, say, 5 years ago, cloud computing, particularly in the public cloud, was just beginning to take off. Now it's a really significant capability in financial services. So again, bank CEOs need to be thinking out 3, 5, 10 years in terms of what technology will be available for them to handle that data better.
Now, banks have been described as museums of technology, with many of them running on creaking legacy systems that are in dire need of an overhaul. Now, to what extent is aging technology feeding into the problem of chronic low profitability at large European banks?
Well, it's certainly true that post the financial crisis, return on equity has been extremely poor in most European banks and continues to be so. That's really a combination of factors. Firstly, banks have to hold a lot more capital today, rightly so in my opinion. Secondly, revenues are hard to come by, and that's particularly true in low interest rate environments. But thirdly, the systems that the bank runs, which you referred to as museums of technology, are highly antiquated and very inefficient. I remember, growing up in the 60s, where in this country, in the UK, we had a nationalised car industry, and we were terrible at making cars. We used to do a bit of welding over there and put in a windscreen over there. The product quality was incredibly poor. Now in the UK, we have some of the most automated car factories in the world because we use robotics extensively to ensure quality, eliminate defects, speed up cycle time, and so on. And so actually, the fact that the technology is so old and cumbersome is both the problem, but also rectifying it is the solution for banks. If they can massively automate the way they handle data, then they can improve their economics very significantly.
And how willing and able do you think the current crop of European bank CEOs are to actually spend money on bringing their tech into the 21st century?
So if we were having this conversation 5 or 6 years ago, I'd say that for most bank CEOs, a huge overhaul of their technology was not high on their list of priorities. It was incredibly expensive, often in the billions of dollars, very time consuming, perhaps a 5 to 9 year project. And let's face it, most CEOs are in their job for 3 to 7 years. So for many, they wouldn't have wanted to take on that challenge. But what I'm seeing and what I'm hearing from the people we talk to is that now this has really moved up the strategic agenda. for two reasons. One, because the bank's customers are ever more demanding of digital, again, exacerbated by the experience through COVID. But also the economic challenges that the banks have are only going to be addressed if they can massively automate their cost base. So on the one hand, the openness to really addressing strategically the legacy tech issue is there. On the other hand, because of the work that companies like ours have done, we can now de-risk that. So it's much cheaper to use these new cloud native technologies. It's much quicker. And also it can be done on a component or modular basis. So combination of much greater openness to these ideas because frankly, they're highly necessary, and secondarily, because the technology is there to accomplish it. And we literally see interest from all around the world, bank CEOs who are now contemplating some fairly radical overhaul of their technology.
Now, Anthony, you have previously said, perhaps rather provocatively, that banks could disappear altogether in the next 20 years. Do you still hold this view? And if so, what is going to replace banks?
Well, in some ways, banks are vanishing before our very eyes. If you look at branch networks, for example, not only are the number of branches shrinking, but the number of people in them are shrinking. Here in London, if you walk into a bank branch, there's only about 3 members of staff and no customers. And so they're already starting to change. And in many ways, I think of banking as retailing was 20 years ago, when Amazon was a small company selling books online. Of course, there are many successful retailers today, but many other retailers have either had to change their business model or have gone out of business. And I think the same is true for banks. In my view, it will operate in the following way. Increasingly, the customer relationship will be managed separately from the balance sheet activities of a bank. And for most people, doing their banking is a chore. Sometimes people feel intimidated by banks. So if somebody can make that process easier for you by streamlining the user experience, by using data to make better credit decisions about you, so you can perhaps borrow more money for a mortgage and so on, there's a real market for that. And the companies that can do that, whether they're banks or non-banks, will be very successful. On the other hand, the balance sheet activities of taking deposits and making loans, which is the traditional sort of purview of banks, I suspect that will remain with banks, if only because nobody else wants to do the heavily regulated capital intensive activities. But of course, what happens there is the banks could get pushed down the value chain almost to become utilities where their businesses originated from lots of other organizations. And so I can definitely see that sort of bifurcation of the system in the next sort of 3 to 5 to 7 years' time. Beyond that, of course, there's a question about whether technologies like distributed ledger will replace the sort of fractional reserve on balance sheet banking system that we have to date. And it's certainly conceptually possible in my mind for that to happen. Whether that will happen in a 20-year time frame or not, I don't know.
So banks will still be with us, but maybe not as we have known them in the past.
Exactly.
Great, Anthony, thank you very much.
Thank you. It's been a pleasure.